They say that see, bless you.
You can't see me because I'm both coughing and smiling at the same time.
I'm sure you look great.
This is so interesting. It's for all the audience that's listening. Poor Sam and his internet woes that he has. We have to go into low data mode, so you all can see us if you're watching us on YouTube, but we can't see each other. And I just realizing right now how much of this podcast is based off of like, or at least
Visuals.
for me. Yeah, you guys might not give a fuck what I look like when I'm talking, but I'm just kidding. We actually deeply have a great connection where I like play off of each other. And so I'm struggling to where to jump in. Also, Sam slapped my wrist earlier for jumping in too early. So I'm just trying.
And he said, don't keep talking about my internet. And you're like, guys, announcement.
This is Topline.
Today's episode is brought to you by 6 Sense. 6 Sense Revenue AI eliminates guesswork and arms your revenue team with the data and visibility it needs to create and convert high-quality pipeline into revenue. Traditional revenue technologies can't detect anonymous B2B buying activity. This creates a dark funnel that leads to mistimed engagement or missing out on opportunities altogether. 6 Sense Revenue AI eliminates hidden buyer behavior in the dark funnel while enhancing the technologies you already use. You'll capture every revenue moment and deliver more predictable revenue. Find out more at 6sense.com.
Let's go.
We're rolling.
Let's do it.
We're rolling.
Rolling.
How you guys doing?
Pretty
How are you, Sam?
I'm pretty good.
I am, as I mentioned, I'm a little sick. I'm a little under the weather, guys. We weren't supposed to have this episode. This is a bonus episode, and here I am showing up sick.
But still,
why are you sick?
but you're still answering.
Frightful.
When Asad says, "How are you, Sam?" You're still the one answering, so that hasn't changed.
Yeah, that's the role I play on this. Don't you understand? This is my
Before we
show,
get going,
Sam,
what does AJ think?
What are you doing for your illness? Like, what do you do when you're sick? What's the game plan? How do you get non-sick?
I act like a big baby and sit on the couch while my wife, my daughters have all had this and they've like been super troopers. I have to get like this giant Vicks steaming mask that's actually great, by the way. If you haven't had that, it's not my shout out for the day, but I'm going to give it a shout out. And then honestly, during the day, I just sweat it out. I go for a run. I don't jump in my ice cold plunge. Today.
You go for a run. That's really interesting. I think the trick is if you guys ever feel sick like this, just go get one of those drips. It's really like it changes the game. They shoot in like 10,000 milligrams of vitamin C into your system. That's way more than you can take when you take it orally. And it just if you get the right drip, you feel remarkably better the next day.
That's true. Okay, let's actually ask Sam the question. Sam, how are you doing today?
Today, I'm good. We had our corporate offsite in Nashville, as we talked about, and that was fantastic. And then I went from there to the mountains of Colorado, and I spent Thursday on Vail Mountain with avid Topline listener and Denver Pavilion chapter head Jesse Shipman, as well as Michael Kelly, who was a member and one of our chapter heads in Sydney, Australia, before he moved to Denver. And we snowboarded all over the mountain. And then I was by myself on Friday, and then I snowboarded with my sister and nephew and my sister's boyfriend on Saturday, and came back. And we're having a strong December. I continue to feel very optimistic about the work I'm doing at Pavilion. The rest of my life is not as clean and orderly and tidy, but my professional life is much more coherent than it's been.
Denver must have been amazing. I've never been, but it seems like one of the coolest places in North America.
Well, the Rockies are incredibly beautiful, and it's just very, very special to, as they say, if you're lucky enough to be on a mountain, you're lucky enough.
Ooh, I didn't know that. But I like mountains. That makes sense. Okay, let's jump into this shit, guys. We have a lot to talk about today.
Asad, before we get there, we didn't ask how you're doing. How are you doing?
I'm doing good. Similar to you, I feel really good about work right now. I feel okay about life. Like, I think, life always trails work for me. And so as the market improves, I'm sure my mood keeps improving. But I feel really good about work. I feel really good about where we're ending the year. I feel good about next year. I slept really well last night. I bought a new pillow off Amazon, and I'm surprised how good this $50 pillow ended up being. So I'm a happy camper.
I'm happy to hear that.
Thank you. I'll send you the picture of the pillow. This pillow is crazy. Okay, let's jump in. So we decided to do this episode. We thought that we were going to take a couple of weeks off, but then we decided to do this episode based on the update that the Fed released last week, and we felt that it was important to break it down before we ended the year. So essentially, the Fed got together last week and they announced the following. The first thing they announced is that we're going to hold interest rates steady for 2024. No surprise there. Everybody expected it. We had said they were going to do that as well. But what changed is their point of view on 2024 and beyond. So they indicated 3 rate cuts for 2024, 4 for 2025, and interest rates coming down to 2 or 2.25% by 2026. Now, if you look back in June, things looked really good in the market, and the Fed was projecting interest rates in 2024 to get down to 4.6%. But by September, a lot had changed. The Fed indicated that they might have to hold rates higher for longer because interest rates inflation seemed a bit stickier. They indicated that they expected interest rates to be 5.1% in 2024 instead of 4.6%. And the market reacted to the news. At the time, the All-In folks in one of their episodes started talking about how startups might need to have runway all the way into 2025, potentially even 2026. And the public markets were reacting to all of this news. So a lot of the growth stocks took a hit during this period. Consumer sentiment was down as well. But since then, we've had a lot of positive news about the macro environment, especially when it comes to inflation, which is the main variable that dictates the Fed's actions. So last week, we discussed how inflation's down to 3.1% from a peak of 9%. The job market has stabilized in a good way. Without unemployment going up, we've seen a decline in wage growth and job growth, and that's a good thing. Consumer spending is the thing that has essentially facilitated the soft landing. So consumers make up 70% of the US GDP, and they spent their way they spent quite aggressively, led to a 5.2% growth rate in Q3 from the GDP perspective. And the lowest GDP growth was for a 2.1% in Q2, way higher than any other Western economy and way higher than anyone really expected. Consumer sentiment is back up after dipping in Q3. CEO sentiment is also up, and the S&P is up 24.2% for the year. So, Sam, last week we discussed how it looked like a soft landing was the most probable outcome for 2024. And how 2024 could be a really good year for all of us and our ecosystem especially. But now one can make that statement with a lot more confidence, a lot more conviction. So has this news changed, how you feel as a person and as an operator of a business? And have you noticed any change within the community and the sentiment people have?
There's a secondary question or a follow-up question, which is, has it changed our revenue targets? Has it changed how we're going to invest? And the answer first, has it changed how I feel personally? Yes, it has. It has. There's a world of things you can control, and there's a world of things you can't control. And when you feel like and they are interconnected, when the things you cannot control are moving with you, then the things you can control are easier. It's like running. You can be in shape, but if you're running into a 20-mile-an-hour headwind, it's going to feel a lot tougher no matter what kind of shape you're in. Now, you can be in great shape, and you still might be able to do 730 per mile. That's minutes per mile, not kilometers, minutes per kilometer. If you're listening in Canada, that's not something we track in America. But anyway, that comment was for Kyle Norton. But the point is, so you can be in shape running into the wind, but it's way better to be in shape running with the wind. And when you see Jerome Powell say, hey, and again, the markets react. The markets are every day trying to effectively price in the future. That's their job. That's what they do. Yep. They are the most current take, whether optimistic or pessimistic, on what's going to happen over the next 12, 18, 24 months. So a lot of the market rebound has already happened, partially because the markets expected some of this. But to hear it confirmed from Jay Powell, and also to understand that rate cuts are coming, is it just means that the headwind has lessened fundamentally. And you can see it everywhere. You can see it in stock market. You can see it in crypto. But frankly, you can even see it, in some of our offline conversations when we're talking about the performances of our businesses in December, where I think all three of us are feeling pretty bullish about it. So, so yes, has it changed how I feel about next year? It has confirmed how I feel. And it also feels like there's a bit of a weight lifted, and that weight came from uncertainty. That weight came from, other people, some of whom we might talk about on the show, feeling a lot more bearish and pessimistic. So to feel like, okay, we're not going to be running against the wind when it comes to interest rates, which in turn will have a ripple effect on public equities markets, which will in turn have a ripple effect on M&A, because everybody's stock, HubSpot stock and Salesforce stock and Facebook stock, et cetera, will be more valuable. Therefore, they can use it as currency to do transactions. All of that, I think, has a salutary and beneficial effect on the markets, which is going to have a salutary and beneficial effect downstream for all of our businesses, even if you're heavily concentrated in tech. So all of that to say, nevertheless, and I think we talked about this last week, but that doesn't mean me and Asad run, effectively, even though we raise money, like we are running our business for profitability. And so does that change how I'm modeling next year? No, it doesn't. It means that I'm keeping a very conservative plan. With our very, very conservative plan, we're still going to have roughly 15 to 20% EBITDA margins. And if we do better than that, we do better than that. And I expect to do better than that, but I'm not counting on doing better than that. And I'm not going to proactively, just based on a little bit of data, tell my board that all of a sudden I'm increasing our target 20%. What I'm going to do is, again, as I mentioned last week, try to remember the lessons of this year and try to stay tight and lean and focused and focus on efficiency. And then I guess the last thing I'll say, and of course I want to hear from AJ, but the last thing I'll say is, lots of people in my company, want more stuff. I want more stuff. I want to make investments. But the way that I think about it is, investments will come from growth. We will fund new investments from beating the plan. That's how we'll think about it.
Sam, have you noticed? Yeah, that makes a lot of sense. I would agree with what you said at the end. I'm thinking about it very similarly, that the plan should stay the plan, but I feel it's really, we pontificate a lot, right? And we actually look at the market and we feel that we have the ability to sometimes look out and make some predictions and hope that it all comes true. But this was so much more validation that that's what we were hoping plays out is what most likely will play out. And it did change. I saw a shift in my demeanor. I saw a shift in how people internally in the business felt, how people in other sectors feel. I was talking to my older brother last night, and he's a money manager, and him and his clients, they feel very, very good about 2024 right now. And so there's a change in sentiment across the board, but it doesn't change, I think, the plan just yet. I think you keep the plan, but you keep a very active eye on signals in your own business. And if things are starting to look really good, you can always reevaluate the plan at that point. This is not the moment to do it. But what about within the community, Sam? Like, are you noticing that there's a bit of a shift in sentiment within the community as well?
Well, the three of us are part of the community, and all of us are feeling pretty optimistic. The answer to that question is yes. I did an Ask Me Anything with our associate community, where we're making a lot of investments in 2024 to make that part of our membership even more valuable. And even some of the questions were around people noticing that the job market had picked up. You'll have that data better than me, Asad. But yeah, I think people are feeling more bullish about 2024. And again, speaking to some of the stuff that we'll talk about later, that's why I feel like some of the bearishness is a little misplaced, only because we've taken and absorbed so many lessons already. AJ's business and his go-to-market team is much smaller than it was at the beginning of the year, as is mine, as is yours. And so we already are incredibly efficient. Doesn't mean that there's not more room for efficiency, but I can tell you that the unit economics of QuotaPath, Sales Talent Agency, and Pavilion have dramatically improved in Q4 relative to where they went in Q1. That's for sure. Q1 of 2023. Sure. So that doesn't mean that, there's not always room for improvement. It just means that I don't think that I sense, particularly, last thing I'll say, is we're running this promotion for people that are out of work. And so we have this on the bench community, and we're running this 50% off promotion. And we've done this a few times this year because there've been so many layoffs, and I wasn't sure if this time when we ran it, whether anybody would be interested. And it turns out this has been our most popular time that we've run this promotion ever. And that's because, why is that? That's because there have been so many layoffs recently. And we talked about in the fall this sense of Q4 capitulation, of companies finally surrendering, making the cuts they need, maybe sometimes shutting down. But my point is, I sense that capitulation has happened. I don't think that there's another massive wave of companies in Q1. I could be wrong, but I don't sense that there's the majority of, there's still probably some tail companies, but I think most companies have said, I got to surrender. I got to make the cuts that I didn't want to make. I'm making them now, and now I'm positioned for an efficient 2024. That's how I feel about it.
I like what you just said. It feels like the cuts are done, but there might be some fall downs, meaning there might be some companies just have to shut down next year, and that'll be big news, and it'll get a lot of attention on social media and on different news channels. But I think the consistent cuts across the entire ecosystem, you're right. Like, we've been cutting the whole year. Like, it's done. AJ, how do you feel about all of this? Did your sentiment change when you saw this? How do you feel right now about next year?
I mean, we're anecdotal data, and so like we're giving our data from our company perspective, and I appreciate Sam's perspective on it, and I totally agree on the unit economic part of it, and how I'm feeling right now is fairly positive. But there's actually I think I read this question. It was, how can the economy be booming but people still feel drowning? And so like obviously there's this whole world that exists that I just thinking through, where unemployment, is down. Gig work is up. So you have a lot of people that are delivering their DoorDash or their Grubhub and making $13, $14 an hour, but they're maybe not working full time or working to make ends meet. I think this inflation aspect of it, we're still burning off like that consumer spend. So we're still seeing the wage stay stagnant, and coupled with the layoffs that we saw at the beginning of it, I feel like that the economy booming is really like, okay, you're seeing the stock market and you're seeing the profitability, Sam, that you mentioned, climb. I don't know, I still feel like there's a consumer sentiment that still needs to change, and people need to still feel like wins. I think we are the front line, meaning you, Asid, myself, and Sam, the front line to that. And then going back to our people, and like as Sam mentioned, being in Nashville and just being really bullish about what next year looks like. That's fantastic, and we should still continue to do that. It's a tricky, finicky thing, and it's multifaceted. I think in our little tech bubble, because we were down so much at the beginning of the year, of course we're going to feel up, which is great. And we have only one spot to go up, but I think it's a little lumpy in other parts of the economy and how people are feeling.
In higher.
Sorry, just to add on to what AJ said. Asid, we talk about like declining inflation, but that, let's say inflation is 2% year over year relative to last November, but last November was 8% relative to November of 2021, right? So we're still looking at over a 24-month period. The reality that, a gallon of milk, gas has actually eased a little bit, but like everyday goods, even if they're only increasing at 2% year over year now, they're still up 15% from where they were just 18 months ago. Mm-hmm. And I think we kind of tend to miss that a little bit when we talk about easing inflation, is the reality that prices are at a new normal. And also I think it takes some time for people to, it takes time for me, right? I just bought a protein bar at the deli, and and the guy's like $4.82. I'm like, oh, wow. Okay. And I bought a big thing of coconut water, like the good kind. I guess it's called Harvest or whatever. And it's like the one that's pink because it hasn't been oxidized yet or whatever. And it's like $13 at my local bodega. And I'm like, maybe I don't need coconut water that bad. So anyway.
Normal Aquafina.
So just some thoughts.
The one area, Asa, that is really interesting, and we're all homeowners. And I think the one area that is just still trying to figure, and I don't know what this looks like, it kind of got unwound in 2007, 2008, is just the housing market. I mean, in Canada, it's even more challenging. But in the US, it's becoming an issue as well. It's just there's a lot of folks in their mid 30s that are renting, and the rental market, it can be brutal. So that's one area where I'm just like, I can think people can feel like they're drowning if they're just like having to pay rent every month versus putting money into a mortgage and equity.
I don't know about that. Like, I've never bought a property. Like, I invest a lot of
Oh,
money in a bunch of other things, but I don't like buying the house that I live in. And I feel like that actually makes me feel a lot better about navigating the market, because I'm more liquid than if I was to put a lot of money into a really big and nice house. So I like the flexibility, I like the liquidity, and I invest in other areas. And it's worked out really well for me from a return perspective, because I can generate a way better return investing in equities because I get them and I know how to do it decently than I could probably do in real estate. So I don't know if everyone just naturally feels that way. What I do know is that I agree with your point of view on inflation and the pressures that inflation has, and how there are different segments of the economy that are feeling different levels of pressure. I think when it comes to tech, it's the highest of highs and lowest of lows. It's a high risk asset class, and it's going to have more pronounced highs and more pronounced lows. And we've gone through a tech recession caused by inflation and interest rates. So I do think that it really relieves a lot of pressure from the part of the economy that felt the most pressure. We ate the most shit over the last couple of years, and it's just really nice and positive to see that pressure is going to lessen. The rest of the economy is interesting. Like, I think it's strangely stable. Like, it has its challenges, but the consumer had built up a lot of savings. They haven't gotten through all those savings yet. And now the economy might start picking back up, meaning that they might not even destroy all the savings that they'd built up in COVID that they were spending through. They might not even get those down to zero by the time the market picks back up. And the assumption was that it would go down to zero, and then credit card spending and debt would increase. And hopefully, while that happens, inflation comes under control. This is a really good sign. People hold on to their savings to some extent. Unemployment historically low. Is it the best type of employment? No. There is some strange data around the fact that more people past retirement age are working now than ever before. But a large percent of working people are working right now. That was a challenge before, but it's still good to have low unemployment. And the fact that wage inflation has slowed down, that was a positive thing. There's still a lot of jobs. For every person that's looking for a job, there's more than one job available. And so these are signs of a stable economy, not a walk in the park, which is why what they achieved is so complex and so remarkable. But it is the US economy is a remarkably resilient economy, and the consumer is a big part of that. AJ, how do you feel about Jerome Powell, actually? I was thinking about him last night, and so this is what I was thinking. They say that, bless you.
You can't see me because I'm both coughing and smiling at the same time.
I'm sure you look great.
This is so interesting. It's for all the audience that's listening. Poor Sam and his internet woes that he has. We have to go into low data mode, so you all can see us if you're watching us on YouTube, but we can't see each other. And I just realizing right now how much of this podcast is based off of, like, or at least visuals. For me. Yeah, you guys might not give a fuck what I look like when I'm talking, but I'm just kidding. We actually deeply have a great connection where I like play off of each other. And so I'm struggling to where to jump in. Also, Sam slapped my wrist earlier for jumping in too early. So I'm just trying to...
And he said, don't keep talking about my internet. And you're like, guys, announcement.
Yeah, this is everyday life. This is what Asid and I have to deal with every week. So
sorry, Sam, till you upgrade that internet, you're going to hear shit from us. Okay, so let's bring it back. So Jerome Powell, I think they say that CEOs have two very interesting characteristics. They are disagreeable by nature, and they're optimistic by nature. And I feel this kinship with Jerome Powell because I feel that he's shown founder CEO vibes right here.
Yeah.
He did something that was non-consensus and he got it right. Yeah. He was optimistic about pulling off something that literally no one in the history of the world had pulled off, which is to manufacture a soft landing with a reactive monetary policy. He pulled it off. He had conviction, I can do this when everybody says I can't. Do you feel any kinship towards him?
Listen, yeah, we're besties. Actually, give him a call all the time and give him my updates. I do think that entrepreneurship is just so funny because I've had multiple board calls. It's the end of the year. We're all talking about financial planning, and it's the hardest thing for me personally as a massively optimistic human being, but also someone that needs to be as objective about the business as I possibly can. It's really challenging. And so if like Powell has that same point of view around the economy, that it's like his baby, then great. That's fantastic. It's really challenging in a communication front. And so I got to applaud him for that.
Yeah.
And just being consistent with messaging and what we're trying to do. And he's given us the keys. He's told us what we're going to do. Like none of these moves have been surprises, right? We were all, even though the stock market ripped last week when this happened and was announced what was going to happen next year, we all knew that was coming, right? Like this is what we've been talking about. So, I think it's all about expectation setting. And as a founder, that's also the challenge, right? You have an optimistic nature of like, yes, we can go out and do that. But that's a conversation you're having with yourself. And that's why as the CEO is the loneliest road here is like, you can tell yourself, oh, we're going to go all to do these things and run through walls. And you get your team excited, but then you have to have other conversations at the board level where you have to set the right expectations. So it's a very, very challenging position to be in. And sure, I feel great kinship with Jerome Powell.
I think he's an inspiring figure. Like, we always look for other tech entrepreneurs as a point of inspiration and people to learn from. I think the person who you have the most to learn from in 2023 is this guy. Like, who's achieved something more remarkable than him, right? And so communication, expectation setting, conviction, all of that shit, like this guy has shown it more than anyone else I've seen in the market. And I would say once the soft landing is said and done, it'd be strange if he didn't get like a Time Person of the Year type of thing. Sam, any lessons from Mr. Jerome Powell for you as you wrap up this year, knowing that he's done what he said he was going to do, but most thought he wasn't going to do?
Well, Asad, I think this is a very optimistic take because you can make the argument that Jerome Powell created a massive mess, and should he be celebrated for cleaning it up like a big boy, or maybe he shouldn't have made the mess in the first place? I think that's what's
a good take.
The counter argument would be he created, he was through quantitative easing, not just through interest rates, but through the Fed intervention and the monetary supply, that like he was overly aggressive in 2020 and 2021, that their COVID reaction was over the top and over indexed. And as a consequence, he created the massive hangover that we've all had to suffer for. And that if you're out of work, you can also blame Jerome Powell. So,
that's a really good take. That's a very interesting take.
I mean, that's what all my friends in the financial markets don't, think. Some of them share your opinion, and some of them say like he made this mess in the first place. I don't think he should be celebrated for nominally trying to clean it up. But I also think hindsight's 2020.
I guess a question on that, Sam, because thinking about that point, you said he made that mess, but that boom in liquidity we saw in 2020, was that his decision? And I mean, created this large wage price spiral that like has created inflation, but I felt like there was just a giant momentum. Like we have to do PPP. We have to help everyone out. Like
Trump and Biden plus. I think it was the central banks of the world overreacting. But again, hindsight's 2020. So I personally like Jerome Powell, but and I don't think. Listen, I think the greatest sin of COVID was shelter at home and keeping kids out of school, and the damage that it did to their socialization and to people's ability to interact with 100%. Each other. But I do not think that the greatest sin of COVID was aggressive financial stimulus to pay people to stay at home, because we'd never been through a global pandemic before. So I think it's easy to say that they overreacted and whatever, all of the different weird, the Inflation Reduction Act, all of these very strange bill names where the Inflation Reduction Act, the purpose of it is to increase inflation. But anyway, I think there's a plausible argument that would I rather overcorrect and have a little bit of a pullback, which from the world's perspective, they're not so heavily indexed on alpha assets like the tech economy. So everybody else doesn't feel the same level of of pain that we've all felt this year.
Yeah.
And so I think that the Fed acted well, to be honest, even though, you know, a lot of people would disagree with me, and I tend to be on your side, Asad. And I guess the lessons are only the lessons that we've all talked about over this entire time, which is we were drunk on excess, and it forced us to get in shape, and it forced us to become better leaders and CEOs, and that's great. Let's not forget those lessons. Let's not go back to levels of excess in 2024. Let's keep our heads down. Let's monitor our spending, both personally and professionally, and let's learn to live within our means.
I like it. I like that other perspective on it. I agree with you that I think it's in hindsight, I can see they were not perfect during that period, but you can justify making some of those mistakes because of the moment in time that we were in. I think you judge a person on how they react to their mistakes, and the way that they've reacted to the mistake, let's say if it was even a mistake, the way they've reacted and steadied the ship is just remarkable. So I find it quite interesting to be able to see and observe and to just be part of the economy at that point. It's been quite an educational experience. On that note, we have something really interesting to talk about next. But before we do that, let's pay some bills. A word from our sponsors.
Are you a CEO or founder looking to get ahead in 2024? Then join me, Sam Jacobs, and over 100 high-growth CEOs and founders for Pavilion's 2024 CEO Summit. We're gathering at the Elite Phoenician Resort in Scottsdale, Arizona, to share revolutionary insights and strategies on how to navigate the current economic climate with confidence and certainty. At Pavilion CEO Summit 2024, expect expert-led education sessions, hands-on workshops, and exclusive networking opportunities with fellow CEOs and founders from around the world, including the team from Topline, me, Asad, and AJ. Buy your ticket at joinpavilion.com/CEO Summit and use the code TOPLINE for 20% off. That's joinpavilion.com/CEO Summit and use the code TOPLINE for 20% off. I hope to see you there.
World's best host.
You like the let's pay some bills part?
You're a great guy. You're a great guy.
I appreciate that. Okay, so we have a new paper in the SaaS go-to-market space from the firm that releases papers and does a fantastic job in bringing interesting insights to all of us, Winning by Design. Their paper on customer success, I think, is one of the best pieces of content ever created. It's the number one thing I have shared with people, and I didn't even create it. So huge respect for them. But they published a paper titled, Has SaaS Lost Go-to-Market Fit and What to Do About It? The way that Winning by Design thinks about building a business is that product market fit is about having something to sell, and go-to-market fit relates to how you sell that thing. Now, the thesis in this paper is that we're seeing declining go-to-market metrics across the entire funnel. Growth has declined in SaaS. The cost of acquiring net new revenue has increased from 150% to 264%. The data was sourced thanks to our good friend David Spitz at Benchsides. NRR has dropped dramatically. For public companies, it's gone from 122% in June of 2022 to 113% now. It's worse in the private markets. They then say that while we've seen this declining situation in go-to-market metrics in 2023, shit's going to get worse in 2024. And they think that in 2024, ARR will be more expensive to acquire than 2023, and net revenue retention will be worse. And so then they say their solutions are cut more costs, cut a lot of costs, close products down, fire exec team, just cut costs, like pretty aggressive statements around the cost cutting. Understand, trust, and act on unit economics and improve go-to-market effectiveness and efficiency. And they flagged that AI is very much in its infancy, so it's not going to fix this situation in the short term. This is not something that AI can fix, but they're obviously very bullish about AI in the long term. So the question is that I think they've done a good job at highlighting the problem, or at least framing it. But their framing of 2024 seems to be very bearish, because based on what we just discussed, it's hard to imagine that net new revenue will be more expensive to acquire and net revenue retention will be worse in 2024. And then the advice also seemed a little bit basic, but that might be the situation, right? Like the solutions might be basic and fundamental solutions to the problem. What do you think about the outlook on 2024, Sam?
I agree with what I presume your take to be, Asad. I nothing I'm seeing indicates things are going to get way worse. That doesn't mean it can't happen, but we started the show off talking about what's our outlook for 2024. Well, again, I know it's anecdotal, but my experience in life is that anecdotal data points are not uncorrelated from the rest of the world. It's rare. Let's say that it's rare. Is it possible that AJ's business was doing not that well in the summer and is doing a lot better now, and it has nothing to do with the global economy? Sure, it's possible. Is it possible that my business wasn't doing well in the summer and is doing a lot better now? Sure, I guess it's possible. Are me and AJ special kinds of geniuses, and we recognized the problems in the summer and have taken drastic action to correct them? Yeah, but so did everybody else. That's the whole frickin' point. Like that's the point, which is that we made the changes. So are there a big group of people? It'll be very surprising to employees of Meta and Salesforce and Google that have all been laid off this year that next year more cuts are to come and efficiency is still not where it needs to be. And I think Meta's stock is up, some enormous percent this year because of the changes they made. So do I think things are going to get way worse? No, I don't think things are going to get way worse. I think that things are going to get better. I don't know about how if SaaS necessarily has lost its product market fit. They'll get better from where they are. I think to the point, maybe the deeper point that Yako's making is, but is it still possible to triple, twice, double, 3 times? Is 3 to 5 to 1 LTV to CAC still a reasonable estimate? Is Snowflake style NRR still possible? I don't know that those things were ever quite as true as people made them out to be. So in that sense, I think that the lure of SaaS as a business model is probably gone through a course correction that is more permanent. But on a marginal basis, comparing next year to this year, do I think things will get worse? No, I think things will get better.
Sam, you had a pretty interesting take that you had sent. I think you had dinner with a PE friend who had made that comment, kind of validated what Asa just said, and it was quoted around costs, and that like costs are the thing you can control and like just continue to cut, which I thought was kind of interesting. I don't know if that was in relation to this paper, but anything from that conversation that like matched what Yako's saying here?
No, only because so the conversation was I had a dinner with a mentor and an old CEO that I used to work for that is now in private equity. And we were talking about this year, and he relayed this somewhat amusing, although it wasn't amusing for the people that it impacted, story where he said, last year, I said, so what are the lessons that you've learned from private equity? And he said, the number one lesson is there's always more to cut. And he said, he was talking and apparently he wouldn't say the company, but it's a very famous consumer brand company that this private equity firm was invested in. And he said he was talking to them in last year, so the fall of 2022. And he said, you need to cut 20%. And the CEO said, I'm cutting 7%. He said, if you cut 7%, you're going to have to cut 30% later in about 6 to 9 months. And when you do that, you're going to fully lose the trust and faith of the organization because you're probably going to tell them that you won't need to make another cut after the 7%, and they will not feel like you're telling the truth after you make the 30% cut. And the CEO made the 7% cut. And then in March of 2023, this year, made a 30% cut, almost exactly the way this person had predicted. So, we were chuckling about that to a certain extent because the lesson that this person had learned in private equity for the last 8 years is there's always more to cut, that things are always more efficient, that you always need fewer people than you think, and that companies can always do a little bit better with fewer resources than they think that they can. But I don't think that impacts an outlook on 2024, only because, to the point, like, this is a story about what happened in 2023. This isn't a story about what happened in 2024. So I tend to agree that, the people that say cut deeper once, those people, with the luxury of hindsight, those people are always correct. It's just difficult to know how deep to go, and you're always scared of cutting off growth if the market comes back. But again, the original question is there's a big prediction from this Winning by Design paper that next year is going to get even worse, and I don't agree with that.
We were talking about how CEOs and founders are optimistic and disagreeable by nature, which is why it's really hard to figure out what the right cut is, right? Because you might be getting some sage advice that, hey, cut 20, 30%. I think the fundamental of cut deeper than what you generally think you should cut is very good advice. In hindsight, you are right. It's just that CEOs are optimistic, so they don't play in their mind, play out the most optimistic view of the market and say maybe the right cut is 10%, and then it kind of bites them later on. Hopefully, this is a lesson a lot of people hold on to. I agree with your take on this, Sam. I think their view on 2024 is strangely bearish. I don't see any signals right now in the macro environment that indicate that 2024 is really bad. We see quite the opposite. And the reality is that we function in an ecosystem, and our mood and our company's performances are tied to things like inflation and interest rates. And if those are moving in the right direction, I have to assume that the market is going to continuously move in the right direction, unless there's some type of a black swan event. So yeah, I found that a bit weird. But interesting paper, and generally their papers are very good, so people should go and check them out.
That brings us. I would say that, from private conversations with some of the people that wrote the paper, the black swan event that they are worried about is China invading Taiwan and taking control of the global semiconductor industry. And then I guess there's another black swan event that, Trump or Biden, being old men, pass away, and how that impacts the economy.
That's fair.
Sorry, I'm curious. I don't know. It sounds like Austin has a strong point of view around impossibility of China.
Of the Taiwan thing, I don't think they invade. Why? If you look at the demographics of China, they don't have enough young people. So they cannot afford a war right now where young people go on the front lines and die off. Even any percent of deaths that they don't have to incur, and war comes with deaths, is just something they economically cannot afford. They got the one-child policy wrong. They're dealing with this problem today. There are some really negative implications of this in the future. So a lot, and this is not just my point of view, if you look at a lot of geopolitical experts, when they look at the demographics of China, they don't think that China is in a position to afford any altercations right now that turn into a violent altercation, which the invasion of Taiwan would potentially be. That's why. Okay. So the last thing we have to discuss is something in big tech, which is interesting. So the Adobe and Figma merger is off. In September of 2022, Adobe announced that they were going to acquire Figma for $20 billion. They were paying a 50x multiple on ARR for Figma, which at the time was the largest multiple ever paid for an at-scale software company. And they were paying that multiple at a time where the comparable multiples in the public market was 6.2x. So a lot of people criticized the deal and said they're overpaying. The criticism of that criticism is we had to pay what we had to pay to acquire them. They wouldn't have sold for less than that. And the reality back then was that Adobe had to invest in their future, and buying Figma seemed like a smart way to invest in the technological advancement of Adobe. Then what happened is ChatGPT happened. And that really changed things. There's a platform shift that enabled. And for the first time, there was a huge advantage to the larger incumbent businesses because of the data that they have and how much AI requires data to create really magical solutions. So Adobe has been at the forefront of integrating AI into its tools. AJ uses it to create pictures of me in the bathroom, and they turn out fantastic.
Sexy
I look
pictures.
good on the pot even, guys. That's the reality. And Adobe's stock has done really well since then. They've gone from about 542 last year, into September 22 when they announced the merger, to 620, and the market cap is 275. So you guys might not remember, we actually called this. We said that if you're Adobe right now, you're looking to get out of this deal. You're probably advocating on the back end for regulators to look into this, and you hope that this gets called off. And that's exactly what's happened. Regulators looked into it. They've called it off. Adobe is going to pay Figma $1 billion to walk away, but the deal is done and over with. Since then, Figma's revenue is up to $600 million. At today's multiple of 50 nets of revenue, that's a $9 billion company. Too big to be acquired, but definitely healthy enough to go public. We don't cover big tech as much. We will next year, but let's just start by looking at the downstream effects of this for early and growth stage tech companies, especially from an M&A perspective. Sam, do you see this increasing or decreasing M&A in the ecosystem for early and growth stage companies?
I see it increasing, small acquisitions and medium-sized acquisitions, to the point of Salesforce acquiring Spiff. I think it's a good thing, because I think big companies are saying, all right, we can't grow by glomming on 600 or 700 million of ARR in a 10, 15, $20 billion acquisition, because it's going to invite regulatory scrutiny. But we can grow by doing 100, 200, $300 million acquisitions of smaller businesses that are doing 10, 20, 30 million in ARR. And that's so I don't think it'll have a chilling effect on all M&A. I think it'll have a chilling effect on big M&A, which redounds to the benefit of the companies that me and AJ and you run.
Yeah. That made sense. AJ, Sam referenced the Spiff acquisition, right?
He did it. Yeah, he brought it up. He said he was going to. It's at the end of this episode, so we'll see if everyone gets this like pot of gold at the end of this episode.
Yeah. Okay, so let's talk about this. Spiff was acquired by Salesforce. Spiff is a competitor of QuotaPath. Nowhere as cool and as fancy and as nice as QuotaPath. As a buyer of QuotaPath and as somebody who's evaluated all the other things in the space, you guys are way better. But let's talk about what an acquisition within a category means for the other players within the category. So if it's the first acquisition within a category, how should founders think about this? Is it a positive sign, a negative sign? Like generally, as a founder CEO, how should you think? And what should employees within the other organizations be thinking at this point? Is this the point where you go to your boss and you ask for more equity because your company might also get acquired in the next couple of years?
Oh, thanks for that, Austin.
Yeah, you're very welcome.
To my one employee that listens to Topline.
Ryan Milligan and Graham are going to be knocking on your door, brother.
Yeah.
You're welcome, guys.
No, that's not true. Ryan's working on the financial plan. He doesn't have time to listen to Topline. So, it's definitely a great thing for this space. I think it's just, you have to take at all of these. Like there are obviously times where a company like Salesforce or a bigger company acquires something and it killed. Like look at Clearbit for HubSpot. But HubSpot had dozens of partnerships with Clearbit competitors. So I actually work with a partner that was handling the Clearbit competitors. I was like, oh, tough week for you because he didn't know. And and he'll be fine. But if you're in the shoes of the down market player, you just unfortunately got eaten alive. Now of course we work with Salesforce, but Salesforce has shown time and time again that they're fairly agnostic, even when they acquire. Like you look at the Pardot acquisition back in the I don't know when that was, 2010. It was great acquisition, but of course Marketo and these other players and email cadence platforms at that time, or I guess they were marketing automation tools, even HubSpot themselves, still connected to Salesforce, and they did fine. And I think it just opens up the door for the market and gets everyone like paying attention to it. For us, obviously we're agnostic, but we have a partnership with HubSpot. They're an investor in our company, and I think that puts a part of it on the radar. I was texting back and forth with Brandon Greer, who's corp dev, and we were just talking through what that looks like. But it doesn't really change for me how I'm going to operate or how I do the plan or think about it outside of just like keeping my ear on the ground and just being pretty positive, like just a positive signal. I think though, Austin, it really, to me, it signals what you just said, which is like this M&A opportunity in the 100 to 300 million over the next 2 years. That's what's like loosening up. And you just didn't see any of those deals getting done this year. But you are going to see it because of what you just said. And I think like if you put Figma on the other side of the equation, then what do you need to have on this side of it? Well, you need to have dozens upon dozens in that 10, 20, 30 million kind of getting rolled up, consolidated, changed, and that liquidity could be a great opportunity for some smaller funds. I think where it's going to be interesting is to see the Tigers and some of the bigger funds. Now Spiff didn't have, I mean, their biggest investor, they had Norwest and Lightspeed, but another competitor, Captivate IQ, has Iconic and is at 1.2 billion valuation when they were in tens of millions of dollars in revenue. And so like the question will be what happens to those organizations. But even for QuotaPath, it's something that I think about in, we raised our Series B last year, and it's just like, how do we now fit in the next 3 years? Or should we just make sure we're keeping the eye on the prize in the 5 to 10 year range?
Yeah, that's such an interesting point, right? Because we didn't see a lot of M&A, but it's so clear right now that there's going to be a lot of regulatory pressure for these large acquisitions. People say the reason that Microsoft invested so much in OpenAI was also that they were scared to do it themselves. They were scared to like build this out themselves. You can see the pressure that Google is going through right now. They just lost a big case against Epic.
They have like 3 other cases that are up in front.
Yeah, like
in fact, my really good friend is his wife is like on this case as an expert testimony on antitrust. Yeah, that's going to be the landmark case next year, and people don't even realize it, against Google. It's an antitrust that's gigantic, and Google might have to split up its entities. So it's gonna be interesting.
The case that they just lost was a huge loss because Apple won a similar case, right? Epic took Apple to court, and Apple won that one. And for the very same reason, right? It was an App Store related issue. They're like, you charge too much to be on the App Store and for people purchases that happen through it. And then Google went and lost the same case. Obviously, it's different types of platforms. It's open versus closed, but it's really interesting how Google lost and how much the judge hated Google through this. But one of the things that was just really funny to see was Google has a lot of messages that just get deleted internally. And then even the messages that don't get deleted, the conversations are quite alarming, and can be activating to a jury or a judge. And that's what really annoyed the judge at that point. And I think the judge really had it out for Google in this instance. They did not perform well. Like their case was not fought well, and they didn't put themselves in a good spot over there. So it'll be really interesting to see what ruling comes out, because they still have to make a judgment on it, or they still have to give the sentence. Now, Sam, going back to Adobe for a second, internally, what do you think this means? Like, is this, there's Adobe has lost the acquisition. The acquisition's not happening. There are a lot of people that might have been on track to make shit ton of money and were thinking, you talked about how when in the market was hot, people were looking at new houses, new cars, thinking of how to spend their newfound wealth. I'm sure a lot of that was happening at Figma right now, and now the acquisition's off the table. People's hopes and those dreams are no longer real, at least in the short term. Does that create a really dark cloud within an organization that's hard to navigate past? Or what do you think the internal situation is like in a company when this type of an acquisition falls apart?
I think, first of all, I love you all, but we are running late, so I will say that. But
to be continued next time.
Next time. They got $1 billion. They got $1 billion. So I have to imagine some portion of that went to the employees. I do not think it will be as unhappy at Christmas as we might think. It might be the best possible outcome in some way. I mean, obviously, you want to be worth $20 billion. I definitely think, to your point, Asad, that this was Adobe agitating to get out of the deal and figuring that $1 billion is better than $20 billion. But $1 billion is $1 billion. They raised $330 million. That means there's $600 million on top of that. I'm sure you can pay back. True. You can say, can we keep $50 million out of the $1 billion? Can we keep $50 million for employee bonuses and and secondary, or whatever you want to call it, because they don't need $1 billion in cash. And I have to imagine there's a good outcome for the employees if the CEO and the management team aren't complete idiots, which they're not.
Yeah.
Beautiful. Okay, on that note, let's wrap this up, guys. Shout outs.
This is my last shout out of the year, and it's going to you guys. We've talked a lot. We've spread the love and the cheer around all year round on this group, and I couldn't have made it through this year without you guys. So I will shout out Sam Jacobs and Asad Zaman.
That's very nice.
We love you, Sam.
I'm gonna shout out the people that I work with every day. Particularly my direct reports, my full-time direct reports. I want to give a shout out to Kathleen Booth, to Carly Palace, and to Ann Jusim, and to Kwabena Aseadu. Those are the people that have been part of the management team. Also, Tom Andrews, who we promoted to the executive team, who runs who runs insights and operations for us, or revenue operations and insights, systems and insights. I think he's senior director of systems and insights. But anyway, the executive team at Pavilion have been incredible partners. They put up with a lot of ups and downs. And I feel like we are in the driver's seat for 2024. And I just want to say thank you to all of you. I know that I'm not the easiest person to deal with, and I often put my foot in my mouth, and I often have too much to drink and then record a podcast episode. But nevertheless, I'm incredibly grateful to you. Thank you for all your hard work.
That was a beautiful shout out. Okay, last one for the year. I said something really sweet last time around, so this one's going to be a lot more basic. I want to shout out a publication. I get a lot of questions from our listeners around how we get all the information that we talk about. And the reality is, we do a lot of digging across various different sources, but people then ask, what's the number one source that we should look at on a regular basis? And I would flag the information as a publication that every professional in our space should sign up for. We get a good 20-30% of the stuff that we talk about is from the work that they do. They're a small publication focused on tech, and they are just really good journalists. And so for those who are looking to spend some time over the holidays getting some sources set up for themselves, that's the one to dig into. And with that said, guys, I hope you have happy holidays now. And we're
happy holidays, everybody.
Happy holidays.
All right.
Happy holidays.
Bye, everyone.
Bye, everyone.
Bye, bye, bye.
Thank you for listening to this episode of Topline. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.